the issue had been bubbling along for quite a while, and there was had been a proposal, in my view, never a sustainable proposal for a guarantee limited to $20,000, had been around for quite a while. When pressure emerged, the government wheeled that proposal out. Very fortunately, on a Friday, it took, fortunately, less than 3 days to work out that lots of people have more than $20,000 in the bank, and that if you're told explicitly your guarantee is limited to $20,000, it makes very good sense to be at the bank first thing Monday morning to get all of your money in excess of $20,000 out and distribute it to some other financial institutions to take advantage of the guarantee. So fortunately, the proposal wasn't proceeded with, and instead we got an unlimited guarantee introduced a couple of days later. Now the important point is, having done this, that this was announced for 3 years, having done this, there's no going back. There's no sense in which there can be some day down the track when the government announces, well, look, everything's fine now, so your money is no longer guaranteed. As long as we had a quasi-guarantee, and it wasn't threatened, we could have it. But there's no conceivable way, in my view, that the government will be able to credibly announce to people, your money is no longer guaranteed, but it's still absolutely safe. We need, in my view, in terms of guarantees, to have either explicit guarantees or explicit exclusions. That is, if we're going to have a limited guarantee, it must be clear that if you have more than $100,000 in a financial institution, or whatever number we choose, if that institution goes under, your money goes under with it, and that we are going to explicitly list those institutions which receive a guarantee, those which don't, and make it clear that those which don't absolutely receive no protection. The governments are indeed committed not to rescue unguaranteed financial institutions. And of course, we already have such a distinction. For example, if I take my money, invest it with a stockbroker, I have protections of ASIC to ensure that I'm not defrauded or the victim of financial manipulation, but I'm not protected against my investments losing their value, and I'm not protected against my stockholder failing in the ways that stockbrokers occasionally do. I have to make those investments on my own judgment. So I think the crucial points here are three. The first is that a guarantee without tight regulation is what economists call moral hazard. That is, if a bank is guaranteed that it's going to be bailed out, whatever happens, and at the same time we let it pick and choose its own investments, well, obviously the answer is you pick risky investments, because if they pay off well, you pay yourself gigantic bonuses and the shareholders big dividends. If they go badly, the government is there to pick up the tab. The second point, which I've been hammering on about for 30-odd years, so we'll see if we can get it through this time, is that permeable boundaries between the guaranteed and the non-guaranteed sectors are a recipe for what you can call regulatory arbitrage. That is, if you're a guaranteed and tightly regulated institution, but you're allowed to own a non-guaranteed, non-regulated institution, what you do is get that institution take lots of risks. When it runs into trouble, you run the risk, your institution is threatened with going under, and so the government comes and bails you out. And that happened to the Bank of Adelaide back in the 70s. It was allowed to own a finance company, and a finance company went under, and so the bank had to be rescued while other finance companies were allowed to fail. So in my view, what that means is that if we have substantial links from savings banks, the kinds of things I'm saying should be protected and tightly regulated, to investment banks that are not, this is a recipe for systemic risk of the kind that we've seen in the past. So the policy conclusion I'm advocating is that of narrow banking, a sharp distinction between the guaranteed and protected institutes, banks, and non-protected institutions. Very strong restrictions on the kinds of financial innovations that protected institutions like banks are allowed to adopt. That is, banks, used in this context to mean protected institutions, should be limited to a set of well-understood investments and assets with clearly safe limits on their allocation to those assets. If people want to try something new, they can do it out in the unprotected sector with their own money or with their investors' money. As I say, maintaining the kind of ASIC-type regulation that prevents fraud and manipulation, but with not only with no guarantee, but with clear government commitments not to bail out failed institutions in the unprotected sector. Again, we've seen one of the disasters of the, although of course it didn't affect Australia this time round. We saw this with the bailout of AIG, the big insurance company in the US. It was bailed out because it owed vast amounts of money to Goldman Sachs and the other investment banks. They were bailed out because they'd been allowed to become too big to fail. And so we had a situation where institutions which had been allowed to run free on the basis of assumptions that they really weren't the responsibility of the US federal government, ended up saddling that government with hundreds of billions of dollars in liabilities. So a sharp separation between banks and non-banks, no cross-ownership, no cross-marketing, none of the kinds of situations we've seen with your Storm Financial where you go into a bank and get sold an investment product and then, of course, rely on the deep pockets of the, naturally go after the deep pockets of the bank when things go wrong, and no or limited exposure of banks to unprotected institutions through loans and other forms of finance. So that's a fairly radical change compared to the system we've had everywhere in the Western world for the past 30 years. It's not that radically different, though, from the system that prevailed during the post-war period, when, with a much more boring financial system, admittedly, but we maintained a much higher level of financial stability. Taming the global financial system. So what we've seen from the 70s onwards, a situation where really the financial system ruled the roost. It was governments that were scared of the financial markets and not vice versa, particularly anybody who was around during the 1980s. I can see at least some of us here were, even though quite a few weren't. We'll remember that every budget there'd be a nervous wait to see what the markets thought of it, because the markets were seen as the embodiment of all financial wisdom. I think I wasn't too impressed by that at the time, but I think the notion that the markets embody some kind of superior wisdom is one that really has outlived its usefulness. Once we accept that, though, we need to look at the need to bring down the size of the financial sector in all dimensions. What we've seen has been a huge growth in the financial sector, ultimately based on gigantic moral hazard, on the fact that these guys could make out like bandits while the going was good, and ultimately governments and taxpayers were left to pick up the pieces when they didn't. The only way to stop that is to drastically reduce the size of the financial sector across a range of dimensions: its share of employment, its share of profits, and in profits here I include the remuneration of senior staff, which is effectively part of the profit share, the value of short-term international financial flows. Of course, these have been going rapidly into reverse during the crisis. The gross and net value of obligations in things like credit default swaps, and the political and economic influence, which even now allows a bank like Goldman Sachs, a mendicant on the US financial system, to exert immense political power, which certainly gives our banks, who are also ultimately dependent on us as taxpayers, a huge amount of power to say what government should and shouldn't do. That needs to be dealt with in three ways. First, through tighter national regulation. Second, a new global financial architecture. That's something we hear about every financial crisis. Hopefully this time we'll actually see one. Third, I'd argue we need to look again at the time-honoured proposal for a Tobin tax. I would argue this is Tobin's idea, as a way of scaling back massive international financial flows, was a tax on small tax on international financial transactions. I would argue that the distinction between international and domestic isn't firm enough to make that feasible. What we need is a very small tax on gross value of financial transactions of all kinds. Of course, until very recently, we as retail customers of the banks faced charges of this kind at a much higher level than a Tobin tax would imply. So it's certainly not something which is inconceivable. It's just that it's been inconceivable as applied to the massive transactions of the financial system.